So the United States has been violating Gresham's law since '64, but throughout history, the Chinese did it, the Greeks did it, the Romans did it, the Germans did it. And every time you faked money, Gresham's law, war broke out.
With the dollar at its weakest point recently, world finance has become unstable. Prominent figures such as Robert Kiyosaki have had their say regarding the matter. In this video, we will discuss the reasons behind the dollar's collapse and share the insights of Kiyosaki on staying ahead of time. Introduction: Analyzing the dollar's sudden collapse. In the ever-evolving landscape of global finance, few voices resonate as boldly as Robert Kiyosaki's. Renowned for his astute financial insights and authorship of the groundbreaking Rich Dad, Poor Dad, Kiyosaki's perspective on the sudden dollar collapse has garnered widespread attention. With a track record of timely predictions, Kiyosaki's views hold weight, especially as he navigates the uncharted waters of economic uncertainty. As we move on with the video, let's start with knowing the reasons behind the dollar's potential collapse and Kiyosaki's insights about the phenomenon.
But the message out there again is to most people is poor people don't know the difference between fake money. And the biggest fake thing of all is called the US dollar. And there's people out there, oh, I'm saving money, I'm saving money, I'm saving money. Meanwhile, the frickin' US government is printing trillions of it.
Segment 1. The US Dollars Crossroads. Is the US dollar's reign of strength drawing to a close? The dollar's decade-long bull run is facing a pivotal moment, prompting questions about its future trajectory. From its low in 2011 to its peak in late 2022, the US dollar saw a remarkable 45% surge against JP Morgan's inflation-adjusted, broad-based basket of developed and emerging market currencies. This substantial increase left the dollar overvalued on a purchasing power parity (PPP) basis compared to most major and emerging market (EM) currencies. However, the persistently overvalued dollar has yet to experience a substantial correction, prompting speculation about the catalysts required for a sustained decline. One significant catalyst is the narrowing interest rate differential between the US and Europe. Throughout the pre-COVID era, interest rates across major economies were low, yet the US consistently maintained higher rates than Europe, Japan, and other developed markets. This difference played a pivotal role in driving the dollar's ascent. International investors were drawn to higher US interest rates coupled with its safe haven status, creating a favorable environment. Additionally, attractive forward interest rates allowed investors to purchase euro and yen-denominated bonds, hedge them into US dollars, and benefit from a higher interest rate. However, the landscape has evolved, particularly in response to unexpected market developments. The swift collapse of US regional banks like SVB Financial, Signature Bank, and Silvergate Bank has led to revised expectations for terminal federal funds rates and treasury yields. Concurrently, the European Central Bank, ECB, maintains its rate hiking trajectory in the face of persistent inflation pressures.
Banks, insurance companies, they borrow money at a certain rate, and then they go out and they make investments. And when those investments have lower returns, go down in value, as stocks and bonds have gone down in value, or they don't have adequate yields relative to the cost of funding those assets, you have everybody losing money.
These dynamics vividly depict the US dollar's position at a critical juncture. The interplay between interest rates, economic conditions, and geopolitical events is poised to shape the dollar's future course in ways that warrant careful consideration. Segment 2. So, why is the dollar collapsing? The dollar's trajectory is not isolated. It's interwoven with the broader financial landscape. One pivotal factor contributing to the dollar's decline is the Federal Reserve's actions since September 2022. During this period, the dollar peaked and subsequently began a steady descent. Notably, this peak coincided with the Federal Reserve's balance sheet reaching its top and the money supply hitting its highest point. The correlation between these events indicates that the market was reacting to the potential oversupply of dollars, making them relatively less valuable. As the Federal Reserve aims to curb inflation, it raises interest rates. incentivizing saving and disincentivizing spending and investment. High interest rates, often seen during an economic expansion, prompt individuals and corporations to save more, resulting in a shift toward a more conservative approach. The increased cost of debt also plays a role, as higher interest rates make servicing debt more burdensome. This overall environment cultivates a scarcity of dollars, making them more valuable than other currencies. However, the market's response to the Federal Reserve's actions demonstrates that its anticipatory nature often outweighs the dollar's current value. The market's consensus dictates future expectations, and during the dollar's peak, it was pricing in a future scarcity of dollars, making them more valuable. As the dollar index declined, it wasn't indicative of an immediate drop in value, but rather an expectation that the Federal Reserve's future actions would devalue the dollar. The decline in the dollar is also influenced by the market's anticipation of lower interest rates, which can be attributed to several factors. First, the resignation of President Bullard of the St. Louis Fed, a proponent of higher interest rates, signaled a potential shift in the Federal Reserve's approach. This raised speculation that the era of rate hikes might be ending. Second, the market's anticipation of a recession lowers interest rates. As economic activity slows down, spending decreases, prices fall, and the savings pool grows. This dynamic fosters competition among savers to lend their money, lowering interest rates. Lastly, the market's pricing of deflation further contributes to the expectation of lower rates. During deflation, the real value of money increases as prices decline. This reduces the need for high interest rates to protect against inflation, leading to a downward push on interest rates. The dollar's decline is not solely based on its present value, but on the market's projection of its future value. The Federal Reserve's actions to counter inflation and the ensuing scarcity of dollars played a significant role. However, the market's anticipatory nature also comes into play, influencing expectations of future interest rates, recession, and deflation. As a result, the declining dollar reflects the market's consensus on these multifaceted factors shaping the financial landscape.
Observing this and our country in a situation where it's very difficult to create an interest rate that is high enough to provide a real return. In other words, a return after inflation that is high enough to compensate you for holding that asset, to provide that interest rate that's high enough at the same time as not damaging those who have borrowed that money.
Segment 3. Kiyosaki on dollar collapse. Robert Kiyosaki's viewpoints echo his concerns about the fragility of the traditional financial system and his emphasis on financial education and preparedness. Kiyosaki is known for his candid and critical perspective on conventional economic wisdom, and he often advocates for taking a proactive approach to safeguarding one's financial well-being. Kiyosaki points out that the dollar's decline reflects broader economic trends and policies. He would likely emphasize that inflation, interest rates, government debt, and geopolitical events influence the dollar's value. He expresses his belief that the traditional banking system, as it stands, is vulnerable to disruptions, and this could contribute to the dollar's decline. Furthermore, Kiyosaki emphasizes the importance of understanding the implications of a potential dollar collapse. He cautions against complacency and encourages individuals to educate themselves about the possible scenarios that could unfold. Likewise, he warns against relying solely on traditional investments denominated in dollars and instead advocates for diversification into tangible assets like commodities, real estate, and potentially even cryptocurrencies. Segment 4. Other economic factors that might lead dollar to its end. Beyond interest rates, a mosaic of economic factors is converging to shape the US dollar's future direction. Let's explore these factors and their potential impact on the dollar's standing. 1. Economic outlook across markets. The global economic landscape is undergoing shifts that have implications for the dollar's trajectory. China's economic reopening has breathed new life into growth prospects, with consumers displaying pent-up demand and indicators of both manufacturing and consumer activity on the rise. Europe, once grappling with potential energy crises, now presents a more promising picture as forward-looking manufacturing and service sector data point to improved conditions. In Japan, despite inflation pressures, resilient consumer demand and a recovering service sector could bolster the economy. Emerging markets also see enhanced growth prospects as central banks swiftly reacted to inflation by raising rates. This improved economic outlook paints a changing landscape that may influence the dollar's path.
Because they are so systemically tied to one another, as the Treasury Secretary calls them, systemically too big to fail, like Credit Suisse was, they will be bailed out. So they're just these behemoth banks that have created balance sheets that are so intertwined with one another systemically that if they fail, it would have ramifications for the entire global financial system.
2. Portfolio flows and the euro. Europe's hostile interest rate policy and quantitative easing measures are transforming. As policy rate differentials between the European Central Bank, ECB, and the US Federal Reserve narrow, the driving force behind euro weakness and dollar support may diminish. Notably, Europeans have been buying more foreign bonds than international investors into Europe, resulting in net outflows from the Eurozone. This dynamic could evolve, affecting portfolio flows and the euro's standing. 3. Japanese yen's potential shift. The Bank of Japan's BOJ policies have historically suppressed the yen's appreciation against the dollar. Yet, signs of stronger inflation are emerging, potentially prompting the BOJ to unwind some of its policies. Allowing yields to rise could support the yen, making carry trades more expensive and influencing the yen-dollar dynamic. 4. Emerging markets and monetary policy. Emerging markets have responded assertively to inflation, raising interest rates to support their currencies and attract income-seeking investors. This approach has effectively bolstered currencies like the Brazilian real and Mexican peso, which saw strength against the US dollar. However, the future relationship between emerging market currencies and the dollar hinges on the US Federal Reserve's rate decisions and economic conditions. Segment 5. How does Robert Kiyosaki want you to prevent yourself? Robert Kiyosaki's philosophy underscores the transformative power of financial education. He famously said, "The more you learn, the more you know you don't know." This sentiment underscores the significance of understanding economic forces shaping our financial world. Armed with this knowledge, you can make informed decisions that align with your aspirations and ultimately your fiscal well-being. Diversification, as Kiyosaki often emphasizes, is a formidable shield against uncertainty. "Don't put all your eggs in one basket" rings true, especially during uncertain times. Kiyosaki's advice resonates. Diversify your investment landscape. This involves judiciously allocating your resources across diverse avenues, from time-tested treasures like precious metals such as gold and silver, which have acted as bastions of value throughout history, to the ever-evolving domain of cryptocurrencies like Bitcoin.
I own lots of real estate. I own lots of Bitcoin. I own cattle. Okay. I own oil wells.
Diversification isn't just a strategy, it's a prudent shield against potential currency depreciation. The concept of tangible ownership holds sway in Kiyosaki's playbook. Precious metals shine as tangible reservoirs of value when currencies falter. Historical records affirm that gold and silver sparkle as shields against potential dollar debilitation. Similarly, the sector of real estate, embodying stability and potential appreciation, resonates with Kiyosaki's endorsement of income-generating assets. In the spectrum of alternative investments, Kiyosaki's counsel is straightforward. Approach with scrutiny and sagacity. Cryptocurrencies emerged as a novel avenue reflective of the evolving financial landscape. Kiyosaki would counsel thorough research, understanding the risks in parallel with the potential. He says, "It's not about how much money you make, but how much money you keep." Kiyosaki's clarion call for an entrepreneurial mindset reverberates louder during uncertainty. As he champions, the richest people in the world look for and build networks. Everyone else looks for work. Multiple income streams guard against economic tempests. Whether through side ventures, income-generating assets, or leveraging your talents, this philosophy echoes the importance of resilience and adaptability. Likewise, strategic awareness is paramount in Kiyosaki's worldview. Staying abreast of global economic shifts, central bank maneuvers, and geopolitical tremors is critical. This aligns with his assertion, in today's fast-changing world, it's not so much what you know anymore that counts, because often what you know is old. It is how fast you learn. Seeking advice from seasoned experts is a cornerstone. Kiyosaki values tailored guidance from those who navigate the labyrinth of economics. Furthermore, Kiyosaki believes preparedness is the bedrock of a sound financial strategy. This doctrine includes creating an emergency fund, fortifying access to essentials, and devising a plan to navigate market turbulence. With an eye to the unpredictable, Kiyosaki champions that preparation is empowerment, positioning you to stride confidently into the unknown. Conclusion: with times as uncertain as it is currently, it is essential to understand the economy and prepare ourselves. In this video, alongside explaining the reasons that can lead dollars to a dark future, we shared the insights of Robert Kiyosaki and his suggestions that can help us be steps ahead. While there is very little we can do to protect the dollar from collapsing, we can certainly protect ourselves from the imminent impact that will be there if the dollar collapses. So, applying the recommendations of Robert Kiyosaki, let's educate ourselves and avoid the uncertainty of the future. If you like this video, drop a thumbs up and subscribe to our channel. Don't forget to check this video to learn more about the world economy and finance. See you in the following video.